Hey, welcome back to Invest Like. If you're like most of us, you've probably taken a peek at your portfolio today. Maybe even noticed some gains or drops that got you excited or a little nervous. But what if I told you there's a legendary investor who doesn't get caught up in these emotional swings? Warren Buffett, one of the most successful investors of all time, doesn't let daily market movements shake him. In fact, he's mastered the art of long-term, steady investing. Today, we're diving into the key mindsets and rules that Warren Buffett lives by when making investment decisions. These principles aren't just for billionaires. They're for anyone who wants to build wealth slowly and steadily over time. And no, this isn't financial advice, but it is an opportunity to learn from one of the greatest investors of all time. Rule 1. Never lose money. Let's start with Buffett's most iconic rule. Rule number 1, never lose money. Rule number 2, never forget rule number 1. This rule isn't just about avoiding mistakes, it's about protecting your capital at all costs. Buffett isn't aiming for the quickest, highest returns. He's laser focused on minimizing loss. And here's why. If you lose 50% of your capital, you need to make a 100% gain just to break even. Those kinds of losses are much harder to recover from than they might seem. How do you follow this rule in your own investment? For Buffett, it's all about buying with a margin of safety. This means you only invest in assets that are priced below their true value. By doing this, you build in a cushion, lowering your risk and safeguarding your capital, even if things don't go as expected. Practical tip: when considering an investment, always ask yourself, what's the worst case scenario? Focus on finding opportunities where your potential downside is small, but the upside is strong. This mindset will help you stay calm and confident during market downturns. Rule 2. Stay in your circle of competence. Buffett often says risk comes from not knowing what you're doing. That's why he sticks to what he knows and understands best, his circle of competence. He avoids industries or businesses he doesn't fully grasp, no matter how trendy they might be. This approach is exactly why Buffett avoided tech stocks for many years. Even though others were chasing the tech boom during the dot-com bubble, Buffett stayed out because those businesses didn't fit within his expertise. Instead, he focused on companies with simpler, more predictable business models, like insurance, railroads, and consumer goods. Practical tip: look at your own investments. Can you clearly explain how each company makes money and why it's likely to continue doing so? If not, it might be time to reconsider those holdings. Stay disciplined and avoid chasing the latest trends if you don't fully understand them. Rule 3. Patience and the power of compounding. At the heart of Buffett's investment philosophy is patience. One of his most famous quotes is, "The stock market is a device for transferring money from the impatient to the patient." Instead of trying to time the market or flip stocks for quick profits, Buffett lets the power of compound interest do the heavy lifting for him. Buffett buys businesses with the mindset of holding them for decades, not just months or years. He doesn't worry about the daily or weekly fluctuations in price. Instead, he's focused on long-term growth and the magic of compounding, earning interest on your interest. The longer you hold a solid investment, the more significant the impact of compounding becomes. Practical tip: ask yourself, could I hold this investment for the next 10 years? If not, you may want to reconsider it. The key to benefiting from compounding is holding onto high-quality assets for the long term, letting their growth compound over time. Conclusion: Warren Buffett's approach to investing is built on principles that are as simple as they are powerful. Protecting your capital, sticking to what you understand, and being patient enough to let compounding work its magic. These timeless rules have helped him become one of the richest people in the world, but they can be applied to any investor's portfolio, no matter the size. To recap Buffett's key investing principles: never lose money. Protect your capital above all else. Stay in your circle of competence. Only invest in businesses you understand. Be patient. Let compound interest grow your wealth over time. Keep these principles in mind and you'll be well on your way to building a portfolio that can weather any market condition, just like Buffett.